Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I'm your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And I really appreciate your time today. Thank you so much for listening. If this is your first time listening, welcome to the show. And February for me, in my practice, is usually the month where I'm reviewing and getting in touch with clients and reporting to clients about their progress towards financial independence. And the way I do that is I track a metric for all of my clients. I call it total term. And it's basically just your current net worth divided by your current annual spending. And what that tells us is how many years of spending can your net worth support? And ultimately, we're aiming for maybe something around a 20 to 30 year period, right? We want to make sure that your net worth can sustain a long-term retirement. So that's sort of our benchmark. And this is something I actually talked about earlier on the podcast. You can go back to episode 22, how to track progress towards financial independence. So that's the benchmark figure, the vital sign that I'm tracking and I'm reporting on right now, and I'm touching base with and having conversations with right now. So February is a month all about tracking progress towards financial independence. And one thing I want to touch on today is something that often comes up in conversations, or something I see in Facebook or social media groups, something I see in books, for example. And that is the 4% safe withdrawal rule. What is the 4% rule? What does it mean? How do we use it? When do we not use it? What does that actually mean? Because it's thrown around and it's used a lot around planning towards retirement and planning for financial independence. So where does it come from and what does it mean? That's what I want to dive into today. Today, I'm going to talk about what the 4% safe withdrawal rule is, where it comes from, what research it comes from, what are some of its limitations, when should we use it, what is it used for, and what are some of the takeaways that we can learn from the research around it. So let's start with, what is the 4% safe withdrawal rule? Well, essentially what it means in theory is that if you take 4% as an initial amount out of your portfolio in the year you retire, and you simply you increase that amount each and every year for inflation, you should, in theory, be able to go throughout a 30-year retirement and not run out of money, right? So if your starting dollar amount is 4% of your portfolio, and you just adjust it for inflation over time, in theory at least, you should be able to get through a 30-year retirement and not run out of money. Where does that come from? Well, it's a research observation. It's based on research done originally in a 1994 paper by Bill Bengen, who was a financial advisor. And I put a link to that paper in the show notes. And Bill was living in a time where, based on his recollection, there was really no solid research done around what is a sustainable amount of your investments that you can take out each and every year when you retire. So Bill tried in his paper to give a framework around choosing an optimal or a safe withdrawal rate by looking at actual historical performance data from 1926 through early 1990s. And by withdrawal rate, what I mean is that, well, how much can you actually take out of your portfolio, right? You've got all these investments, you got a 401k, IRAs, maybe a taxable investment account. Well, what percentage of that can you take out of your portfolio each and every year so that you can spend it? That's what a withdrawal rate is. And so if you have a $1 million combined portfolio and you want to have a 4% withdrawal rate in year one, that's $40,000 that you can take out in year one, right? So in Bill's research, in his paper, he has several assumptions there. He's assuming a portfolio of stocks and bonds with the S&P 500, which is the largest 500 companies in only the U.S., representing stocks. And in the bond corner, he had intermediate term U.S. Treasury bonds. He looked at initial withdrawal rates, so whatever that first percentage was in year one, and then after that first year and throughout retirement, adjusted that dollar amount for inflation. So if there's inflation, if prices are rising, he increased the withdrawal amount by the inflation rate. And if there's deflation, prices declining, you decrease the dollar amount. So you adjust that for inflation over time. So you start with that 40,000 4% withdrawal rate in year one, and then the next year has 3% inflation. So that dollar amount is now $41,200. So Bill looked at, what if someone retired at every year since 1926? And assuming a certain mix of stocks and bonds, he looked at different withdrawal rates and watched how many years did the investments last before that retiree ran out of money. Because in his mind, the retirement goal that he was trying to solve for was, what can you spend out of your investments throughout retirement and not run out of money? So what came through that paper, what came through that research was the key insight that everybody grabbed onto up until today, which is that the highest withdrawal rate in year one that allowed for at least 30 years of retirement spending without running out of money in every single period, meaning even the very worst historical periods, was about 4%. And in fact, it was just over 4%, like 4.1%. So there we get the 4% safe withdrawal rule, that you can start with a 4% withdrawal and just increase it or adjust it every year for inflation. And based on all of the historical periods of the time, even the very worst one, that would have made it through at least 30 years. And this was supported by other research. So in 1998, there was another study called the Trinity Study, which was from 3 professors from Trinity University, which looked at someone retiring each year from 1926 to 1995, and given a list of assumptions, right? So a certain mix of stocks and bonds, this time using corporate bonds, a certain amount of time period of withdrawals, so 15 years of withdrawals, 20, 25, 30 years, and a range of withdrawal rates in year one from 3% to 12%. And they looked at success rates. They looked at what percentage of retirees' lifetimes made it through all these periods without running out of money. Right? So they're looking at a success rate. What percentage, what probability did you have to make it through based on the mix of stocks and bonds, the amount of time you're withdrawing, and also your withdrawal rate, your rate of withdrawing. And the analysis supported basically what Bengen saw, which is that a 3 to 4% initial withdrawal rate was pretty conservative, especially if you have a heavy amount of stocks in the portfolio. And as withdrawal rates increased beyond 4%, the success rate dropped. So from 100% to 90s to below. And so we have this 4% withdrawal rate, which was that initial rate that you can start withdrawing in year one from your portfolio that survived even the worst historical time periods of returns and inflation at that time. And this is something that's continually studied from that point up until today, and was really a springboard, it seemed, for decades of retirement research. Bengen himself updated his research as he got more data. He added in other asset classes, which is probably more realistic to how people should be investing, beyond just the S&P 500 and beyond just intermediate U.S. bonds. And found that when adding in other asset classes like small cap and micro cap, the smallest stocks, international and different things like that, the new safe withdrawal rate was actually about 4.7%, which is sort of an argument for greater diversification, because those smaller stocks, especially small and value stocks, have a higher expected return compared to the largest U.S. stocks. At least that's what history would show. So Bengen has updated his research over time. If you follow the Financial Advisor publications, he's written in there about other factors that play into this as well. Others have continued to research how retirees spend money, or withdrawal rates, the best mix of stocks versus bonds, when it makes sense to adjust that throughout retirement, and whether this approach even makes sense, and everything in between. So this 4% rule is often talked about. It's often referenced. And how do we really use it responsibly, right? What is the best way to use it? When shouldn't you use it? So first, I want to talk about some limitations. First, it's based on historical data. And I use historical data all the time to create reasonable expectations around a lot of different things. But the future is unknown, right? The future returns, future inflation, all of that is really unknown. So while the past may be the best guide we have, and it is really helpful for building reasonable expectations, you do have to keep that in mind when relying on something that's built on historical returns. Secondly, it's a research observation, right? So this isn't a law like gravity is to physics. Like, this is really just a research observation with very specific assumptions around how money's invested, how long your retirement will be. It's continuing to be updated as more data is available. For example, I know Bill Bengen has talked about wanting to include things like REITs, real estate investment trust, and whether TIPS as inflation-protected bonds would be helpful. But we just don't have the data yet. So if your own life deviates from those assumptions, you have to take that into account. Third, it's probably not how retirees actually spend money. There is research out there and continuing to be done about how retirees spend money throughout their lifetime. And some of it you'll see is that it can be very much like a smile instead of like this very straight line, this linear increase over your life. And what you might read about is that, in the earlier years of retirement, there's a higher amount of spending, or it tends to be closer to what those initial retirement goals were. And then spending may dip in middle retirement as that retiree or the couple gets older, less energy or just less things they'd like to do or accomplish. And then spending tends to increase much later in life as healthcare expenses start to creep up. So it may not really reflect reality in terms of how people spend their dollars. The next thing, fourth, it really doesn't account for other sources of income. It ignores things like Social Security or pension income, which is really rare. Especially if you're in private practice, you're not going to really see a pension income. But if your spouse is employed somewhere that does, or maybe if you work at a larger employer like a Kaiser or something like that, you may have a pension benefit. But the 4% rule sort of ignores these other income sources, and it also ignores other assets in your net worth, such as rental real estate or practice equity, or even your residence if you're willing to use the equity there as a part of your retirement planning. So taking these other assets into account and other income sources into account can significantly impact the amount you can or should withdraw, or change the timing of that. For example, maybe you do take a higher percentage of your portfolio earlier on, knowing that it will be much lower later as Social Security and other income sources kicks in. So it does ignore those other factors in your life. It's also based on one single goal, right? So spending down all of your dollars or getting through 30 years of retirement and just getting above $0 left, right? That's really all that matters in this analysis there. You got to keep in mind your own estate planning goals, your own legacy goals, your own retirement planning goals. It's a gross withdrawal number. What I mean by that is it just tells you the dollar amount that comes out of your accounts. It doesn't tell you what you should be doing with that dollar amount. So it ignores a lot of the planning around how you or should be spending or how you want to spend that dollar amount, how to manage things like taxes and expenses, Medicare planning, all that other stuff. And it doesn't tell you how to make adjustments, right? Bill writes about making adjustments in his research in that paper, but the 4% rule in and of itself doesn't tell you what adjustments need to be made as you get to that point. So there's definitely, like any research out there, there's definitely some limitations, even though it's used quite commonly. So where does it make sense to use it? Well, it is great as a rule of thumb. It is a really great, incredibly helpful benchmark and helpful in tracking progress. It's a great place to start your planning and start the conversation around getting towards or working towards financial independence. And it gives you some quick math to plan loosely around. So for example, let's say you spend $8,000 a month, which is $96,000 a year, and you want to replace that, you want to replicate that in retirement. That's your idea, at least right now, of financial independence. And so what would you need to save? What would you need to have in all of your investment accounts to roughly recreate that spending, right? So you can withdraw out of it and roughly recreate that $8,000 a month. Well, you can use the 4% rule here. And you can, for example, you divide $96,000 a year by 4%. It's going to give you a loose target of $2.4 million to create that same amount of spending in today's dollars. So then you can start to ask yourself, okay, I know my loose target is $2.4 million. What do I need to save each month in order to get me there with a certain assumption about rates of return over a certain amount of years, right? So you can start to back into this math, and that math is helpful. It's more helpful as a rule of thumb than having nothing. I mean, than sort of guessing all the time whether you're saving enough or where you're heading towards. So that is certainly a really helpful rule of thumb and a framework to at least check your own withdrawals and say, okay, am I spending more or higher than I should? At least there's something to reference. It's a great reference point. Even for me, for practitioners, for advisors. 4% rule is a great reference point, and all the research that's come out of it has been incredibly helpful to figuring out what is a reasonable withdrawal rate and how do we even analyze that? How do we even come to a conclusion about that? So it's been really helpful for us as a profession, and it's similar to the benchmark number I mentioned earlier, which was current net worth divided by current spending. And there's a similar thought process behind that. It's different in that I look at how many years of spending your net worth will support. And I do like that figure a little bit better because it takes into account your whole net worth instead of just your investment assets. And it also forces you to dive a little bit deeper and say, okay, is the mix of my net worth appropriate based on my retirement goals? It also takes into account current annual spending. So as your lifestyle adjusts, which it likely will as your income grows, as your family grows, as your values change, that benchmark number that I use, this total term number, will adjust for that. But in either way, it's a similar thought process behind it. It's a benchmark. It's a starting point towards figuring out, okay, are we financially independent? And then you need to dive in a little bit more, because true retirement planning, it needs to look at your specific needs and goals, your mix of assets and income sources, and test rigorously the specific variables in your life. And then like anything else, you have to review as the years unfold, and you have to make adjustments as needed. So what are some interesting takeaways though? Knowing that, what are some interesting takeaways from Bill Bengen's research? Number one, because there are some actually really interesting takeaways to look at here. So number one, it's not only the returns that matter in your portfolio, meaning the average returns over time, but it's the timing of those returns. We call that, it's the sequence of returns, the order of which those returns come. When you look at a lot of these sort of retirement projection spreadsheets or these investment growth spreadsheets, a lot of time it's using a flat rate of return over the whole time period, right? There, you plug in, okay, I'm going to plug in 8% rate of return. It's just going to assume a flat 8% rate of return over the entire time period. But that's not reality. In fact, you probably will never see the exact average rate of return in your investments. What you're likely to see is a fluctuation around that average. And sometimes it's huge fluctuations, really high positive rates of returns or really low negative rates of returns, right? And so the timing at which your returns come is really important. What you don't want, what is really detrimental to you if you're heading to a place where you're near retirement, is for there to be a substantial decline and also high inflation right as you're retiring. Because not only did your assets decline in value, but now you have to start selling those assets, selling those investments in order to create cash to spend. So you're seeing a pretty serious combination that has a really negative or can have a really negative long-term impact on your retirement plan, right? And so that is a really bad sequence of returns. Really early on, you're getting negative returns. And even if you have much higher returns later on, it may not be enough to lift you out of that hole to start with. On the other hand, you can have really positive sequence of returns, meaning you may have really good returns earlier in your retirement, which can create a huge buffer for negative returns or even higher than anticipated spending later on. So that timing of returns when they come throughout your life in retirement is really important. And it's maybe most important right as you're getting to and right as you start retirement. That is a sort of this, the term I've heard is like this retirement red zone, but those are critical years. And you have to think really carefully about what your mix of stocks versus bonds versus cash is and what you'll withdraw from if a decline did happen. So that sequence of returns matters. And it also matters if you're not even close to retirement, because it's likely if you're listening to this, you're probably quite away from retirement. You're maybe several years to maybe a couple decades away. So that sequence of return is also really important during your saving years, because if you're saving, if you're a long-term investor and you're still investing, what you want is actually the opposite. What you want is a lot of negative years early on, because you're able to invest during those declining years, during those negative years, and you're able to buy all of these shares of investments at cheaper prices, cheaper valuations, which, assuming that you are broadly diversified, right? Assuming you're broadly diversified, can actually help your long-term returns quite a bit. So the reality is you want a lot of sales, a lot of declines to happen in the years that you are investing heavily. But that may not happen. You may get a lot of positive years when you're just starting to invest and your portfolio is smaller, and maybe poorer returns later on when your portfolio is larger. Unfortunately, that's something we can't control, which is why I am a huge fan of that idea that the earlier you can start to invest, the earlier you can get dollars in these accounts, the more you're able to take advantage of these returns whenever they come. And the best way really you can protect yourself from that is to have a really strong savings rate, right? To have a really strong dollar amount, a percentage of your income that you are investing throughout your career. So sequence of returns risk is important. The number two takeaway that I take away from research like this is that it's not only returns that matter, similar to the first one, it's not only returns that matter, but inflation. Inflation is a huge variable in having a successful retirement. And the timing of inflation is important, just like we talked about earlier, the timing of returns. Because ultimately, retirement planning is all about having enough assets and having enough income sources to cover your lifestyle expenses. That's really to boil it all down, that's what you're hoping for. And having enough growth in your stuff, growth in your assets to support the growth, the inflation of your expenses. So that inflation rate is incredibly important over time. And you may have years where it may not be the greatest decline from a percentage standpoint for your investments, right? So it may not be the worst performance, but if you have a high enough inflation rate, that combination may be more detrimental than having just a 1 year where you have a significant decline. In fact, Bill in his original research, he pulled out 3 different events, historical events that were significantly bad events, at least at that time. And he looked at 1973 through 1974. He looked at 1937 through 1941, and then he looked at the Great Depression years, 1929 through 1931. And the Great Depression years had a total return for the S&P 500 from 29 to 31 of negative 61%, right? Significant. However, he didn't consider in his paper that to be the worst period. In fact, the worst period was 73 through 74. Which had a negative 37% return. So it had a pretty significant decline, but it also had a 22% inflation rate over that time period. The Great Depression years had a negative 15 inflation rate. So actually had deflation. Your standard of living decreased. So that combination of returns and inflation is actually really important. That's something you want to keep in mind. And that's also part of why having a healthy amount of assets like stocks and real estate in your net worth are important so that you can drive the growth over time and above and beyond that inflation rate, or at least to keep up with that inflation rate. Which leads me to the next interesting takeaway here is that the mix of stocks and bonds and real estate in your life matter, and they matter a great deal. So in Bill's research here, he actually found that the optimal mix was somewhere between 50% stocks and 50% bonds to 75% stocks and 25% bonds. And increasing your allocation to stocks closer and closer to 75% actually improved some of the outcomes there. So there is an optimal mix that Bill Bengen found in his research. The Trinity study also found an optimal mix. But I'll note, none of them are at the extremes. And you want to be careful about the extremes. So Bill Bengen in his research warns against going the extreme in either direction, having too little stocks and having too much bonds, which can be extremely detrimental because you are buffering the downside, but you are severely limiting the upside over your lifetime. But he also warns against going 100% stocks, fully stocks, and that did not have the most optimal outcome. And part of that is that increase the severity of those large declines. And if you are starting to sell and withdraw from those portfolios at 100% stocks, you're selling those shares at a much, much deeper decline. So we talk a lot, if you are still working, still in your career, about the right mix of stocks and bonds for you. And oftentimes it's quite heavy in stocks. The younger you are, especially, or the higher your risk tolerance, and often at 100% stocks. And if you're going to maintain that throughout your retirement, it may seem like it will improve the outcome because it will juice the returns over time, but you need to be very careful about that, especially thinking about what you will do during large declines. Where will you pull from? And part of the benefit of bonds is that you can pull from those more stable assets during stock declines. So the mix of stocks and bonds do matter. Although one of Bill Bengen's notes is that too few stocks does more harm than holding too many. So you do want to be careful about being too conservative throughout your lifetime. You want to make sure there's enough gas in the tank, enough assets there that will drive the growth of net worth over time. The last takeaway I'll mention here is that adjustments are important. Adjustments are incredibly important. Bill talks about different periods where investors earlier in their retirement saw really substantial declines or had a really good investment experience early on. And in the times where he writes about the time where the retirees saw a substantial decline early in retirement and high inflation, adjustments are ultimately going to be made. And two adjustments he mentions are possible there. You can lower your withdrawal rate, so you can bring back your spending, if possible. And the other one is that you can increase your stock allocation, which is fascinating because our first reaction when we're, especially a retiree, especially when they're just starting retirement and they see a significant decline, maybe over a couple of years, that first reaction is going to say, let's go to safety. Like, let's sell out of stocks, let's own more bonds, and let's preserve what we have. But that is actually, according to this research and other research I find as well, is that that's actually the opposite of what you should do. The reality is you actually should lean more heavily into stocks because you allow yourself to ride that recovery. I mean, there's been substantial recovery power throughout stocks. Of course, there's no guarantee of how that looks in the future, but that has at least historically given you the opportunity to ride the recovery and allowed the later growth of your portfolio to be much stronger because there's more stocks than bonds. And so that's an important takeaway to me, is that adjustments are important. And this matters regardless of where you're at in your career. Even if you're earlier in your career, you have a ton of financial decisions to make around student loans, around housing, around career decisions, whether to open or buy into a practice, business decisions. And ultimately, life is really just about making the best decision you can with the information you have, and then making adjustments as you go. And that's especially important as you get towards retirement age, is that, okay, you start with an initial withdrawal, you start with an initial retirement plan with the best information you have, but then you have to see how things unfold. You have to see how inflation unfolds. You have to see how your spending and the returns of your investments unfold. And then you have to make adjustments from there. One interesting bit of research around this that I've seen is that there has been research around different methods of withdrawal strategies. So, for example, this 4% rule just starts with an initial percentage and then just adjusts it for inflation over time, right? So it's really static, it's linear, it doesn't change at all. Well, there's been research over the years now, and this is something that a lot of advisors have put into practice for those that work with retirees, where instead of just doing that sort of static, flat adjustments over your lifetime, you're able to adjust the withdrawal amount based on what happens with returns and what happens with inflation. And so this is something called a guardrail withdrawal strategy, or a guardrail strategy. And so that's where you start with an initial withdrawal percentage. And in fact, they've seen often where you can start with a higher withdrawal percentage, so maybe around 5.5%. And then you have guardrails on each side. So you have a upper guardrail of maybe 7% of a withdrawal percentage, and then a lower guardrail of maybe 4%. And so you start with withdrawing 5.5% of your portfolio. And then over the years, there's rules built into this system where based on what happens with the returns and based on what happens with inflation, you're either going to keep your withdrawal amount flat, you'll increase it, or you'll decrease it. And what that does is it keeps you within these guardrails. And that also helps you sort of build in these adjustments into your life so that you're not always having to think about, should I cut down spending? Should I not? How do I know whether to do that? So it keeps a lot of that guesswork out of your mind, and it builds this sort of systematic framework around making adjustments throughout your retirement. So it's really interesting. I know a lot of practitioners have put that into practice, and so adjustments are important. So there we have it, the 4% rule. We talked about where it comes from, what are some of its limitations. We talked about some of its uses. It's a great frame of reference. It's a great benchmark. It's a great starting point in your own planning. It gives you something to at least reference to start to make decisions. And it's definitely not the be-all, end-all of retirement planning. But it's a good starting point. And for us as financial advisors, it's really fascinating to give us a framework to helping clients make these kind of decisions. And it's really exciting to see all the research that's come after that to build on top of it. And so hopefully that was helpful for you as if you ever hear that term, at least you have a better understanding of what that's used for. And I want to leave a final word from the Trinity study here. All right, so this isn't from Bill Bengen's research, but this is from that other study I mentioned earlier. And the authors wrote there that, what then can be done to help an investor in planning for a withdrawal rate? The word planning is emphasized because of the great uncertainties in the stock and bond markets. Mid-course corrections likely will be required, with the actual dollar amounts withdrawn adjusted downward or upward relative to the plan. The investor needs to keep in mind that selection of a withdrawal rate is not a matter of contract, but rather a matter of planning. And I think we can say that for basically anything involving long-term financial decisions, is that this is a constant system of making decisions with the information you have, watching things unfold, seeing how your own values in life changes, and then making adjustments as you go. Constantly course correcting, keeping a sort of agile approach to planning in your life. So hopefully that was helpful. If you have any questions on any of this or anything else, you can reach me. Just an email would work, Evon, EVON, at optometrywealth.com. You can check out all the show notes and resources I mentioned in research in this podcast episode on the show notes of the episode. You can find the show notes from just scrolling down in whatever app you're using, or go to the Education Hub on my website, www.optometrywealth.com. And while you're there, you can check out all the other episodes and articles and resources we have put together. And of course, while you're there, feel free to schedule a no commitment introductory call, and we can talk about what's on your mind financially. We can talk about this, and you can learn more about how we help optometrists all over the country navigate the most important financial decisions in their lives. So really appreciate your time. Hopefully this is helpful, and we will catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.